Hello, everyone. We're going to give everybody a couple more minutes to get in here, but excited you're here to learn more about renovation lending with Cardinal Financial Wholesale. Be back in just a second. Hello, everyone. Welcome. Thank you so much for coming today. We're going to give everybody, just a minute. So many people are trickling in just as I'm talking, so we're going to give it about one more minute and then we will get started here. All right. Hello, everyone. We've got quite a few here, so we're going to go ahead and get started and hope that other stragglers trickle on in. Welcome to our third installment in our renovation lending series with Cardinal Financial Wholesale, featuring Sean Thompson, our VP of Renovation Lending. Excited to talk to you today about the different products and stuff that Cardinal Financial Wholesale offers. We have an additional webinar still coming up that Sean will talk about, what he's going to cover in those as well. Some housekeeping before we get started. So we have disabled the chat for this webinar, but we have enabled the Q&A feature. So if you have any questions throughout the webinar, please go ahead and drop those into the Q&A. Sean can see them as he's going, or we'll also do a live Q&A at the very end after he's done kind of presenting. So we might save your question for that, or he might actually address it while he's talking, just depending on the nature of the question. So please don't hold back. Ask as many questions as you want. We are slated to be done within 30 minutes. That's like the technical one, but we actually, the last two have gone a little bit over that with questions. Feel free to drop off at the 30-minute mark if that's what you need to do. We are recording the entire webinar, and you will receive an email with a recap and that link to the recording afterwards. So even if you have to leave a little bit early, you will still have access to all the information at hand. In addition, please, of course, before we get started, if you are not already signed up to be a broker of Cardinal Financial Wholesale, please go ahead and apply to be one. It's a very, very easy process. You can go to our website, cfwholesale.com, and right up there, very, very easily, you'll see it says become a broker. It is a very, very easy form that you can start with, and somebody from our team will reach out to you and get that process started so that you can start lending with us. So with no further ado, I will introduce Sean Thompson here, who's going to take you through all of the great stuff that he has to cover today. We hope that you learn a lot and that you find these valuable. Please, in addition, you will, in that email, you'll also receive a survey about the webinar. Please fill that out as well so that we can continue to make these more and more valuable for you. All right, Sean, take it away.
Thank you, Victoria. Thank you. And hey, if you're returning, welcome back to our third installment. These are moving along quite swimmingly. I've never used the word swimmingly before. First time. Quite swimmingly, I'll say. But we're happy to have you guys. The takeaway on this particular installment series, if you will, for you guys is that no one size fits all when it comes to product selection. So we're going to do a bit of a product deep dive on this. I think selection is really important and most often overlooked when determining which renovation loan to use, considering that customer's profile, their situation, their needs, and what they're trying to accomplish. The better you understand product nuance, the more likely it is for you to win that deal against another LO out there who does. understand product nuance. So we're going to go into a bit of product deep dive. I'm going to give it to you in a bunch of different ways, which products we offer. In the last session that we did, I teased our classes of reno products, right? So you may have seen this before, but today we'll go much deeper into that dynamic. Of course, it is the project size and type and credit profile that are the two biggest pieces to determine, which hole that customer peg should fit into, right? But as you're going to see, it gets a little bit deeper than that as we go through it. Here's our product classes again. And if you remember the last session, we talked about spotting reno opportunities. And this one, I'm going to connect the dots, to making sure that those opportunities are easily paired with the right reno product, right? So let's go ahead and jump right in. These classes, before I get to that page, really, I want to go back here. The way you're going to hear me talk about the way the products are organized is probably a little bit different, than you've seen before. We put them into 3 different classes: limited, moderate, and extensive class. The thought being, that based on the size of the renovation, you would have a pretty healthy direction of which products you ought to be offering, based on the size of the renovation, right? So we're going to cover the first class, the first section here, which is limited class renovation. By my definition here, not only mine, but the 203K limited is also a limited class product. But I'm defining it as less than 35,000, simple in scope of work, meaning things like flooring and appliances, and simple projects that don't involve changing the floor plan or anything structural or any new building components, right? That being said, with us, you get the limited, the 203K limited, the ever popular 203K limited, brought about in 2006 from FHA. I got mixed feelings about the 203K limited and how it ought to be used. At the end of the day, it's not $35,000 in repairs. It's about $30,000, $31,000, because when you put contingency and soft costs on that, which have to be included in that number, it all has to be below $35,000, right? So there's a misnomer around there around 203K limited that's kind of bothersome. I would say newbie loan officers to renovation make this mistake all the time. We try and squeeze what ought to be a $50,000 project into the 203K limited because we think somehow that's easier, right? The term 203K limited, like you do all this to avoid hiring a HUD consultant, which I think is unhealthy in a bunch of different ways. Number one, there's the customer, the contractor, and possibly a realtor, all right, kicking the tires on the health and safety or quality of or condition of the property. No one there knows minimum property standards other than a HUD consultant who you're neglecting not to use on a 203K limited, right? Being one of them. So I am sensitive to that, and you ought to be too, right? So I think the bottom line, that the takeaway for the 203K limited, if you took away anything from this bucket at all, would be don't forego getting the actual size of the project that your customer needs just because you want to avoid a HUD consultant. There is no benefit to that. There's no lift. A lot of times what happens is we get appraisals back, right? An appraiser will point out things that we could have caught 2 weeks ago had there been a real project there, right? So be mindful about that. The 203K limited isn't an easier version. It's designed for bona fide smaller projects that don't involve any structural changes. So be mindful of that, right? It's about $31,000 in repairs, not 35 as well. You get 180 days to complete them, of course, right? And you can use the 110% of the after improved value dynamic, which we talked about on the last call with the 203K limited. I'm going to move next over to Choice Reno Express. I got a lot to say about this, right? Directly from Freddie Mac. Freddie Mac got out of the reno business in the early 2000s, came back in, I don't know, roughly 2.5 years ago, came back into the market with renovation products, those products being newly named Choice Reno and Choice Reno Express, right? What most people don't realize is a good degree of the market, of the industry, of the renovation lending market, a good degree, probably 65% is the number that we land on, is conventional renovation loans Most of that, all right, is done by Homestyle today. But there's not much you can do with Homestyle that you can't do with Choice, right? So I'm going to get a little more specific about Choice Rental Express, seeing as we're in the limited class bucket right now. Directly from Freddie, there's not much lift you get on Choice Rental Express over Choice Rental Standard or the regular Choice Rental, except when the repairs are less than 10% of the after improved value, right? Because that loan can be securitized without recourse, which is kind of what happens in the back end. We don't have recourse on those loans. It's less risk for us, should be less price for you. And also there's less fees up front when you have a $35,000 or a project that is less than 10% of the after improved value. It's not really about $35,000 on that. In other words, if you have a $400,000 after improved value and a $38,000 project, that can still be Choice Rental Express. Bottom line, Choice Rental Express you use for projects you know that are going to be smaller than the after improved value, right? And you should get a speed lift there, a lift in cost and closing costs for the customer on that, right? Easy Path Reno. Easy Path, now I've teased Easy Path Reno on all three sessions with you, and it is not a product, so to speak, as it is a feature of Choice Rental and Choice Rental Express that allows your customer to use a big box store like the Home Depot, Lowe's, or if you're in the middle of the country, Menards. And if those stores are going to, in fact, do the installation of the materials that you're buying, then in 3 easy steps, we roll that into the customer's mortgage. There's no need for them to hire a contractor. All right. Super powerful. Super powerful. As I like to say, for realtors, the pitch is go into the contract today, go down to the orange store, pick out flooring, appliances, and a new roof for 60 grand, and we'll roll that into the mortgage. No need to hire a contractor, right? Very powerful, very powerful. That's Easy Path. And that rounds out our limited class of renovation, right? Let's go into the moderate class here a little bit. This is the sweet spot. National average being somewhere in the mid 300s for loan amount, national average being somewhere around $75,000 to $90,000 in repairs, making the moderate class renovation the likely go-to on most of the projects that you come across, right? So that is, in my definition here, is $35,000 to the $100,000 mark. Still no major floor plan changes, right? We're not doing anything big to the house. We're not doing additions or anything like that. We'll get to that. But the moderate class renovation is the 203K standard, all right? Obviously, we're all familiar with the 203K standard. If you're not, all right, you could spend a good degree of time. Minimum amount of repairs in a 203K standard, unlike the limited, is $5,000. The limited has no minimum. There's no floor. But at some point, it doesn't make sense. You're not going to do a renovation loan because you want $200 worth of repairs, for example, right? So $5,000 is the floor on the 203K standard, right? But this is what we use for the bigger projects, right? You get 180 days to complete the project. First extension is generally granted, almost always, or I'd say 100% of the time, extending you to 365 days or 12 months to complete the project on a 203K standard. HUD consultants are needed, right? And if you're not familiar with what a HUD consultant does, I would suggest you take a quick Google of that and look at it. The market's filled with HUD consultants. There's some states that have more than others, all right? If you don't know one or your customer doesn't know one, we're more than happy to help you with that when you originate the loan and assigning a HUD consultant to your case. Choice Reno and Homestyle. Homestyle, I'll say this a lot today, is on the way for our wholesale channel. Not offered yet, but on the way, so much so that I'm going to talk about it here, right? Choice Reno and Homestyle allows our borrowers to get a little bit more flexible with the project, right? So we have 450 days to complete the projects. And what I mean by flexibility, is the way the guideline reads is so long as the project improvement is affixed to the real property or dwelling, right? It's allowed to be done, appliances notwithstanding. So what do I mean by that? It means if you can do it, if it's attached to the real property, appliances are allowed, even though I don't really see people pick up the refrigerator and take it with them to the new house when they leave, or the stove for that matter. You could argue maybe a microwave or whatever, but generally speaking, people leave the appliances behind, but they're not affixed to the real property, right? Nevertheless, they are allowed to be financed, is my point. It allows for second homes and investment properties as well, right? So this is, to me, the most used conventional, these conventional products are the most used renovation products in the industry. Kind of lockstep with the way the market works in general. FHA, Govy buyers and borrowers lean towards Govy, right? And our conventional borrowers lean towards conventional for the appropriate reasons, right? You know, you have a 3.5% down, 6% seller concession on a 4-family. That's a 203K, right? You know, so you have a $150,000 pool outhouse addition. That's a conventional loan, and 2 or 3K precludes you from doing a pool. You can use $2,500 to repair a pool, but you cannot install a pool with the 2 or 3K. Not many things you can't do with 2 or 3K, but I brought up the pool just to point that out, right? So there's no HUD consultant needed with us on our conventional products. However, we do have a third party, what I like to call cost analysis or feasibility, some companies will call. All right. It's a one-time $400 charge. All right. And our inspections that happen post-closing are done by a third party company, not a HUD consultant, for about $150, right? Might be $200, right? So what's really cool about that, you know, is coverage. Love HUD consultants, but there isn't national coverage, right? You know, so conventional loans give you national coverage when there are big projects over $35,000, and we need to have this feasibility cost analysis done, right? And the inspections are a lot cheaper than what HUD consultant charges, generally speaking, with inspections post-closing. So it turns out to be a cheaper deal conventionally. Not only that, but we understand what projects ought to fit into that world. I put Easy Path back in here, all right, just to point out or illustrate, as I've done with you guys in the past, that if the Home Depot, for example, is going to install a $150,000 kitchen, right, that's still Easy Path. So long as you're financing the material and the labor for it only, right, and they're going to do the installation, that's considered an Easy Path, meaning no need to hire a contractor, right? We add it to the mortgage in 3 steps. Now, before I leave the moderate class renovation, I really wanted to talk about something. I think it's a good spot to do it, right? The combination of Home Possible, if you're not familiar, Google Home Possible, and Home Ready, which is Freddie and Fannie's mutually exclusive, first-time home buyer credit criteria, for lack of a better term, right? 3% down, lower MI, right? You can combine those with its respective product, meaning Home Possible, Freddie, can be combined with Freddie's Choice Renovation. Home Ready, Fannie, can be combined with Fannie's Home Style Renovation. Okay, so I don't know if you guys are familiar with the duty to serve LLPA reductions that have been happening. This is really, really smart, and I need you guys to pay attention here for this, right? Because what I'm about to tell you is really big, right? So you'll need, or if you have a choice rental or home style, a primary borrower who is purchasing or refinancing, all right, 2 pieces. The third piece of the puzzle, qualifying at or below 100% of the area median income. Don't know what that is, moderator? You can drop that in the chat. The Fannie Mae lookup tool for the area median income. If you have those 3 things, you know, things get really fun, and you get a whole lot of discount directly from the agencies on the LLPA. What do I mean by that? Be sure to visit the advanced section of the rate search function in Octane, and we've made it super easy for you to manage these duty to serve qualifications. In some cases, when you have it, when you're aligned with all 3, we've seen as much as 135 basis points LLPA reductions, right? That's $5,400 on a $400,000 loan amount, right? So I'm gonna put it together for you. Imagine a $5,400 reduction, which you can use towards price, of course, all right, on a home possible, home choice combination with 3% down and $40,000 allowance to go to Home Depot or for a new kitchen or bathroom. All of that can be combined together for one big experience, if you will, right? Right. So, and I bring up the duty to serve dynamic because as loan officers, I recognize you're trained to do what? If a customer has income, you're going to put it on there, right? You got overtime, put it on there. You got, other income, that's not your main W-2 job, put it on there, throw it all on there, all the income, right? What I'm telling you is be sure you can pull back extra income like overtime, for example, that's pushing you over 100% of the AMI to get these LLPAs, right? So now you got to be smart about whether or not you need income that the customer happens to have and it's not a part of their primary job, because the benefits could be huge if you're managing it properly. All right. So I don't want to go too deep in the weeds on that. There's a lot coming down the pike when it comes to AMI management and duty to serve and our ability to get customers in the low to moderate income, struggling for affordability, the right products and the right discounts, right? But it's going to take all of us having a good keen eye about what that looks like in the system. All right. So duty to serve, remember what I told you. Okay. Extensive class renovation, right? This is your large remodels, additions, structural changes, things over $100,000, projects over $100,000, ADUs, for example. I get the question all the time now. ADUs are running rampant. There's ADUs everywhere, right? In 2019, I don't think we even knew what an ADU was. I can't escape that acronym now, right? Apparently the future is going to be one big sleepover. Everybody's going to be attached to your house, sleeping over as a renter, right? So with the big extensive class renovation or extensive class of products, we generally end up using 203K, choice reno, or home style once we do have it coming soon, right? What I will say is we're not adverse to big projects. We do an extra tire kicking to make sure that that $500,000 of repairs is in fact feasible, all right? But we're not adverse to big projects. They don't scare us. Our team's really good at working through those projects post-closing and making sure they finish on time, right? So I want you to be, mindful of that when you're taking them, but so what I'll point out really quickly before I turn the page on the products and we open it up for questions, is upfront money practice and policy with us. I know that's a question that comes up quite a bit. We do allow the contractors upfront money, a percentage of the material costs to seed the project close to closing, not at closing, but once their loan and process account, which is what we call it, is set up, then that contractor can get that upfront money to start the project. Good for you to know as an originator, because remember, if you looked at my scripting from one of the other calls, we talk about how to ease the fears of contractors who have heard stories about this style of business that aren't true, right? So upfront money is one of them. You do get it, right? Financing mortgage payments, on the moderate and extensive class of renovation products, we generally see customers who want to finance, not defer, finance mortgage payments in addition to the renovation. How does that work? Well, let's see. Today is February 6th. If I were to close today, I would skip the month of March naturally, right? February's interest would be due at closing, skip the month of March, and my first payment would be at the doorstep on April 1st, right? March, April. Yeah. Okay. I graduated grade school. So April 1st would be when that first payment would due. If the customer had a $2,500 a month payment and the house was unlivable, meaning while the renovation was being done, I could put as many as 6 months mortgage payments in the financing. It's not deferred. They finance it. They give it to us. All right. We finance it and we pay it we pay it as they go through the project for as long as the house is uninhabitable or you cannot live in it. Right. So that's really cool. Think about my example there. You close today and we have 1 month mortgage payment we're going to pay that April payment. So a closing today doesn't have a first payment come to their doorstep until May 1st, right? Super cool. You can't do that with any other mortgage products, right? You can do that with most of the renovation products, with exception of the limited class products, which are meant to be smaller projects and not to have the customer displaced for longer than 30 days post-closing, right? So I wanted to talk about financing mortgage payments as it comes up a lot. I won't go too deep into the 203K, using the 203K as a refinance dynamic, other than to say, when you are refinancing based on the after improved value and you're using the 203K to do so, not conventional products, then there is an onus on us to establish a bit of equity today, right? So the way the calculator works is it's trying to establish whether or not the customer has, it turns out to be roughly 3 to 4% equity today in order to not come to the table with closing costs against the project, right? So I'll say it that way. If you have 3 or 4% equity today, then your 203K is based on the after improved value, no issues, right? It's when you're upside down today on the as is value, that you could have to bring your closing costs to the table, all right? My team can help you through that dynamic, even on a scenario basis. You bring that to your AE, all right, and they can walk you through it and tell you whether or not you're in that situation. By the way, if you're in that situation, you're in that situation with every lender, not just us, right? So we're just really good at being able to tell you when you're in that situation, not 2 weeks before closing, that you need to bring 20 grand to the table, right? Cool. So let's go on here. That kind of rounds out the products. I wanted to leave a lot for questions because obviously I could talk about products for a long time, right? But I wanted to give you a high enough overview to recognize or take away a couple of things. One, look how wide of a suite of products that is, right? Two, you kind of got to be versed in them to know and predict and which promises to make to your customers so you get them into the right product right away. Nothing pains me more than seeing customers in 203Ks that don't need to be, or vice versa, where they're stretching themselves a lot more than they need to with conventional. And you go, the 203K would have worked out really good in this situation, right? So make sure by the way, we're willing to help you through that. All right. Your AE can deliver scenarios to us in real time, and we get you answers on which product is best suited for that scenario and that customer. All right, Victoria, I'll turn it over to you on this, and we'll answer some questions.
Yeah, awesome info. And there's some great ones that will definitely, get us rolling here. So the first one is a great question. Is Easy Path Reno a Cardinal product?
That's a yes and a no. It is Cardinal Financial's own trademarked Easy Path, yes. But remember what I said, it's a feature of Choice Reno, not a product, right? So it's a way of doing your reno, but you would be adding it to a Choice Reno offering. So if your customer's already getting a Choice Reno offering, they could choose the Easy Path feature, all right, along with it. Kind of plays like a product, but it's not really. So I just wanted to make that separation.
Yeah, we kind of describe it on the marketing side, just since I've talked about Easy Path too, as like the way we do Choice Reno, or one of the ways we can do it. Not necessarily, it doesn't change the Choice Reno, it changes how Cardinal helps you through that process and makes it easier for you. Okay, so next one is, can Reno Express go up to 60K if the AIV is 600,000?
That's correct. That's correct. I believe it is against the hard cost, meaning just the contractor bid, but we don't have a good direction on that. I think today I would say make sure that your renovation plus contingency plus soft costs are less than 10% of the after improved value.
Awesome. Next one's kind of similar. A lot of these are about like different scenarios. Like, is this okay? Is it not? So one is,
Sure.
is Choice Reno loan limit 75% of the AIV?
That's a good question. 75% of the after improved value is not the loan limit, right? So let me get a little bit in the weeds on that question. It comes up quite a bit. There is a part of the credit policy on Choice Rental and Homestyle that limits the size of your renovation project and contingency and soft costs to no more than 75% of the after improved value. I guess the point being is you don't want to finance homes where the bulk of the financing is the improvement, right? So we rarely see that. Rarely see that. I see it in situations where the customer may not have financing, might be owned free and clear, on a house that's worth 800 when they're done, but they want to do a $700,000 project, right? You see the awkwardness of that. That's what that rule is designed to mitigate. People confuse it with the LTV though, right? And I don't want you to be confused with the LTV, right? So it's a different calculation. LTVs on these can go to max 95, 97%, 96.5 with 203K, right? We're just making sure that the project itself doesn't exceed 75% of the after improved value for the reasons I just described. I hope that's clear.
All right, another similar question is, for 2 or 3Ks, is ground up allowed?
Well, ground up is a term usually used for new construction, meaning fresh grass and from the ground up you built a house, right? So that would be a no. However, if what you really mean is a tear down and a rebuild of a house, right? 203K has a provision that allows you to tear down if you intend to keep the existing foundation in its current footprint. You can add to it. Like if you want to do a pad for a kitchen, addition, on top of the foundation, for example, right? Then you can do it, right? It's in the wording. It's quirky. So that means you can use the 203K to tear down if you intend on keeping the pre-existing foundation, all of it. And then you're good with that. I don't see that being a case a lot. With conventional loans, choice and home style, tear downs are not allowed. When you read it, they describe it as you cannot raze, R-A-Z-E, the current property, which the definition means to tear down and rebuild. So that's a no. Conventionally, it's a maybe with 203K if they plan on keeping the existing foundation.
Awesome. What is the LTV of the AIV on choice reno?
What is the LTV on the after improved value? So let's go back to the fundamentals a little bit on this question, right? On a purchase, the cost to buy plus the cost to renovate, all right, plus your contingency. So I'm going to give you some numbers, all right? I've been trying not to do this, but I don't think I can avoid it, right? So you're going to buy for $300,000. You're going to do $100,000 in repairs, right? And you have a 10% contingency on 100,000. So now you're at 410 plus 3,000 soft costs, let's say. Now you're at 413. That becomes your new acquisition cost. Your LTV is based on 413. You have to put down a minimum of 3 to 5% of 413. If your appraisal comes back at 413, you're solid. If the appraisal comes back at $1 million, you still have to put 3 to 5% down of the 413. So not exactly against the after improved value on a purchase. Put that aside. On a refinance, it is 100% based on the after improved value. Should the max loan amount not get in the way, should qualifying not get in the way, should not exceeding 75% of the after improved value in repairs not get in the way, right? So what I mean by that is you're paying off 300,000, you're going to do 100 in repairs, right? You can go up to 95% of the after improved value purely, right? So that's the way that dynamic goes. So on a refinance, you're really against the after improved value. Where on a purchase, you're putting down a percentage of what we call the acquisition cost, if that makes sense. See your AE, and I can certainly get with you and go a little bit deeper on that dynamic. It can get a little confusing to understand, but once you play around with them, you get it, especially when you play around with the worksheets that we give you.
Awesome. One other question is, can you include landscaping in renovation?
You can, particularly when the landscaping is affecting, the quality of the site. You have, trees that are falling on the house. You have, water that is grading towards the property that needs to grade away. You have cracking sidewalks or driveways, things like that, right? They can be done. And if you're smart about the way the bid is done, you can probably fit in some other forms of landscaping that I didn't name there.
A question specifically about Cardinal is when is it on the roadmap for Cardinal to carry VA reno?
Sometime this year, when we bring it to our wholesale channel, I don't have an ETA on that yet. Sorry.
Another question is, do you recommend having the comps from the agent when doing the evaluation?
Well, because you brought up an agent, then I'm going to make the assumption that this is a purchase, right? And most people don't realize this, and most appraisers don't operate this way, although they should, right? And that is just like on a purchase, it's not a blind opinion about the value of the property. The appraiser's highest and best functionality is to seek to validate the cost of the transaction. There's an agreement between two people to buy. The appraiser's job is to validate that agreement. When they cannot, then we get underappraised purchases. Well, the same dynamic exists with reno. The aim for the appraiser is to validate the cost to buy plus the cost to renovate against what comps that end product would look like, right? So to the degree that you could try and predict with an agent what I'm struggling because I want to try and come up with a scenario. Okay, so here's one. It's a 2-bedroom, 1-bathroom house that you're going to do an addition above and add a master bedroom and bathroom, making it a 3-bedroom, 2-bathroom house, right? The house conventionally will be appraised and comped against 3-bedroom, 2-bathroom houses. We don't care about the the as-is value of the 2-bedroom, 1-bathroom house. If you're saying you're going to get realtors to help you comp out what a 3-bedroom, 2-bathroom would comp for in that area closely that we could use within the right proximity, cool. Why not? Right? Why not? Give yourself a little bit of heads up. It's really kind of difficult to do sometimes, right? Because sometimes the improvements you're making are voluntary, right? It has flooring. You just want better flooring. To the degree that that adds the value that you want is always up to the appraiser. But see my previous comment. Appraiser's job is to seek to validate that transaction, not a blind opinion. And the 203K, by the way, you're allowed 110% of that after improved value to be your adjusted value. So should that appraisal come in low, you get a lot of room to still lend the max loan amount, right? So I know that was a mouthful to your answer, but I hope you got the question there.
Yeah, no, I feel like that answered it for sure. And so last question here, like you said, we did go a few minutes over, but we kind of figured we would because we have been, because of all the great questions, which is awesome. So last question is, will we be getting these slides? So we do not share the actual presentation itself, but you will get a recap email from attending this webinar, and it will include a recording of this entire presentation with Sean providing all that context around it, et cetera, including of course, like the recording will showcase the slides as you've seen them today. So if you want access to that information, absolutely reference that recording. In addition, if you ever have questions, if you're like, oh, I just want to understand which products Cardinal has, what your specs are on them, please contact your account executive. That is what they're there for. They're happy to help you and get you that information if you have a specific scenario. They partner with Sean's team to make sure that renovation lending with us is super, super easy and awesome. So please leverage your account executive. Again, that's what they're there for, and they're happy to help. So with that said, thank you everyone so much for attending. Thank you, Sean, for coming in and sharing all your knowledge. We look forward to seeing you at the next webinar. All right, see you
See
next
you
time, everybody.
soon.
Thanks.